You're tuned into the deep dive? Well, you're here because you want to understand finance quickly, efficiently, cut through the noise.
Mm-hmm.
So today we're cracking open a pretty sophisticated trading strategy. It's about arbitrage using Nifty options and Nifty futures.
Right.
Think of it like finding these, tiny mismatches in prices. The idea is to potentially pocket a risk-free gain.
Exactly. It's fascinating, this whole concept of exploiting those fleeting moments when related financial things, instruments, aren't priced exactly as they perhaps should be relative to each other.
Yeah.
And we're focusing specifically on how this plays out with India's Nifty 50 index derivative.
Okay. And the heart of this, the core idea, is something called put-call parity. Sounds a bit complex, maybe?
It can sound that way.
But it's really just a rule, right?
Yeah.
Describing how the prices of call options, put options, and futures contracts on the same underlying thing. So the Nifty 50 here, how they should relate.
Yeah.
Assuming, of course, same strike price, same expiry date.
It's like a fundamental relationship, almost a natural law in options pricing. If you think bigger picture, put-call parity is, well, it's the market's attempt to keep things balanced.
Balanced, okay.
When this relationship holds, the prices are considered fair relative to one another, but crucially, when it doesn't hold,
that's the opportunity.
that's when eagle-eyed traders might spot a potential arbitrage opportunity. It's like that balancing act wobbles.
Right. So our mission, our goal for this deep dive, is to really get how these price imbalances, these violations of put-call parity, how they can be spotted, and how traders actually try to profit from them.
Okay.
So let's unpack the core principle. The put-call parity formula, specifically when we're talking about futures, looks something like this. C minus P.
Call price minus put price.
Right. C minus P is approximately equal to F minus K.
Futures price minus strike price.
Yeah, and the strike price, just quickly, that's the price you can buy or sell the underlying at if you exercise the option.
The key insight, really, is when that equation doesn't balance. When the left side and the right side, CP and FK, aren't roughly the same.
That's the red flag.
That difference, yeah, it signals a possible arbitrage play, that wobble we mentioned.
Okay, let's try some numbers, make it concrete. Say, Nifty spot price is around 24,000.
Okay.
And the Nifty futures for the current month, maybe trading a bit higher, 24,050.
Typical scenario.
Now imagine a call option lets you buy Nifty at 24,000, priced at, say, 200 rupees. And a put option lets you sell at that same 24,000 strike, costs 150 rupees.
Okay.
So if we plug these into our formula, C minus P is 200 minus 150, that's 50 rupees.
Right.
And F minus K is 24,050 minus 24,000, also 50 rupees.
So 50 equals 50.
Looks balanced. Put-call parity seems okay here, no obvious arbitrage staring us in the face.
Exactly. The market in this specific instance seems to be in equilibrium, but here's where it gets interesting. What if, for whatever reason, that same call option was trading at, say, 190 rupees instead of 200? Oh, okay. So now our equation changes. C minus P is 100 minus 150, which is 40 rupees.
But the right side.
The F minus K part, that's still 50 rupees.
Yeah.
24,050 minus 24,000.
Right. So now you have 40 on one side, 50 on the other. They don't match.
That's the violation. That's the potential arbitrage flag waving.
Precisely. And this kind of mispricing opens up generally two main ways a trader might try to exploit it. It depends on whether the price of what we call the synthetic futures.
Synthetic futures.
Yeah, the position we create using the options.
Yeah.
Whether that's cheaper or more expensive than the actual futures contract itself.
Okay, let's break that down. First situation. The synthetic futures is underpriced. So our C minus P is less than F minus K.
In that scenario, the trader wants to buy the cheaper thing, the synthetic futures, and sell the more expensive thing, which is the actual futures.
Buy low, sell high, essentially.
Kind of, yeah. The goal is to profit when those two prices eventually converge, come back into line.
So, going back to our example. Call at 190, put at 150, futures at 24,050, strike 24,000. CP40 is less than FK50. Correct.
So the strategy is, buy one Nifty 24,000 call for 190, sell one Nifty 24,000 put, get 150, and at the same time sell one Nifty futures contract at 24,050.
Right, let's look at the initial cash flow. You spend 190 on the call, you receive a 150 for selling the put. So net, you're out 40 rupees right away.
Okay, a small outflow.
And selling the futures doesn't give you cash up front, but crucially, you need margin. Money set aside with your broker. Think of it as collateral.
Right, margin. We'll come back to that. But here's the clever bit, right? This combination, owning a call, selling a put, mimics owning the underlying asset. Like you bought a futures contract synthetically.
Exactly, a synthetic long futures position. And its effective price, it's like the strike price, 24,000, plus that net cost you paid for the options, which was 40 rupees, 150.
So 24,000 plus 40. It's 24,040.
As your synthetic buy price, and at the same moment, you sold the actual futures contract at 24,050.
Ah, I see. So you synthetically bought at 24,040 and simultaneously sold the real thing at 24,050.
You've locked in a potential difference, a profit of 10 rupees per unit, before costs, of course.
No cost, yeah.
No.
Okay, let's flip it. Scenario 2. The synthetic futures is overpriced. So C minus P is greater than F minus K.
Right.
Let's say the call is now trading at 210 rupees. Put is still 150. Future still 24,050. Strike 24,000. So C minus P is 210 minus 150. That's 60 rupees.
And F minus K is still 50?
So 60 is greater than 50. The synthetic is overpriced.
Correct. So the arbitrager does the opposite trade. They sell the expensive thing, the synthetic futures, and buy the cheaper thing, the actual futures.
Okay, so the trade would be sell one Nifty 24,000 call, get 210 rupees, buy one Nifty 24,000 put, costs 150 rupees, and buy one Nifty futures contract at 24,050.
Let's look at the cash flow here. You get 2 and 10 from selling the call, spend a 150 on the put. That's a net inflow of 60 rupees this time.
Okay, cash comes in.
And again, you got the futures position, buying it, which requires margin.
And this combination, selling a call, buying a put, that creates a synthetic short position, right? Like selling a futures contract.
Exactly. It behaves like a short futures. And its synthetic price is the strike, 24,000, plus the net premium you receive, 60 rupees.
So 24,000 plus 60. That's 24,060.
That's your effective synthetic sell price. And you bought the actual futures at 24,050.
So you bought the real at 24,050, synthetically sold at 24,060. Again, aiming for that 10 rupee difference per unit.
Precisely. Locked in, theoretically.
Okay, so we set up these trades. What actually happens when expiry day rolls around? How did that profit materialize? Because, prices move.
Right. The key thing to remember is that as expiry approaches, the spot price of the Nifty and the futures price, they tend to converge. They get closer and closer, and at expiry, they should be essentially the same.
Okay.
So let's revisit our first example. We bought the synthetic, sold the actual futures. Let's imagine Nifty closes at, say, 24,200 on expiry day.
Okay, above our strike.
Right. So our 24,000 strike call option that we bought, it's in the money. It's worth the difference. 24,200 minus 24,000, which is 200 rupees. The 24,000 strike put option that we sold, well, since Nifty is way above 24,000, that put is worthless, expires at 0.
Right.
And our futures contract, we sold it at 24,050. It now settles at the closing price of 24,200. So we sold lower than where it ended up. That's a loss on the futures leg of 150 rupees, 24,050 to 24,200.
Okay, let's tally that up, the options. We initially spent 190 on the call, got 150 for the put, and the call finished worth 200. So minus 190 plus 150 plus 200.
Mm-hmm.
That nets out to 160 rupees profit from the option side.
Correct.
And the futures leg had a loss of 150 rupees.
Right.
So total profit and loss.
Yeah.
160 profit minus 150 loss.
Right.
That's 10 rupees profit per unit.
Exactly. It matches the initial price difference we identified, the arbitrage worked out.
Wow.
And as the source material points out, if we did the same math for the second scenario where the synthetic was overpriced, we'd also find a fixed profit is locked in at expiry, regardless of where Nifty actually closes. That's the theory of it.
The theoretical beauty, yeah.
Yeah.
But real world, it's never quite that clean, is it?
Almost never. There are some very real, very practical things that can make or break these trades. The first huge one is transaction costs.
All fees.
Yeah, all those little costs that nibble away at the profit margin, which is usually pretty thin to begin with in arbitrage. Brokerage fees, maybe 20 rupees per lot, the source suggests.
Mm-hmm.
Taxes, like the STT, securities transaction tax, that applies to futures and options, exchange fees. It all adds up.
And STT is what, 0.0125% on the sell side for futures and options?
Mm-hmm.
It sounds small, but...
It adds up, especially on large contract values. You absolutely have to be sure the potential arbitrage profit is bigger, significantly bigger, than all these combined costs. For retail folks, honestly, these costs can sometimes wipe out the entire potential gain.
Right. Okay, costs. What else? Margin requirements. You mentioned that.
Hugely important. Trading futures and also selling options, which is key here, means you need to park a good chunk of money as margin in your brokerage account.
It's like a security deposit.
Exactly. It protects everyone involved. The source gives some ranges for Nifty futures. Holding overnight, positional trading, maybe 1,50,000 rupees up to like 2 lakh 25,000 per lot.
Wow, per lot.
Yeah. Selling options unhedged can be similar, sometimes even higher. Hedging can bring it down, but it's still significant. Intraday trading, closing out same day, usually has lower margin needs.
But it's still substantial.
Still substantial, yes. Maybe 80,000 to 1 lakh, but you must close by the end of the day.
Okay. Then there's liquidity. Can you actually make the trades you need to?
Critical point. You need enough buyers and sellers for the specific option strike and expiry and the futures contract right when you need them.
Right.
If the market for that particular contract is thin, you might struggle to get your orders filled, or you might get a worse price than you expected, what we call slippage. That can destroy the arbitrage right there.
And tied to that is speed, right?
Absolutely. Speed is everything. These arbitrage opportunities, if they even appear, they can vanish in, well, fractions of a second sometimes. Yeah, because you're competing against high-frequency trading algorithms. Sophisticated computer programs constantly scanning for these tiny discrepancies and executing trades far faster than any human possibly can.
So the window is incredibly small.
Tiny. And shrinking all the time.
Okay. And one last thing. Holding period. Do you have to hold till expiry?
Well, holding till expiry is what theoretically guarantees that locked-in profit based on the initial mispricing. But some traders might see the gap narrow quickly and decide to close out early.
Take a smaller profit sooner.
Potentially, yes, though closing early means the final profit might differ slightly from the original calculation.
Okay, let's walk through that concrete example the source gave. Nifty spot at 17,815.
Right, this is an older example, but illustrates the process well.
17,800 strike call option at 87 rupees. The 17,800 put at 70 rupees, and the futures are trading at 17,830.
Okay, let's check for arbitrage. Calculate the synthetic futures price first.
Right. Strike price, 17,800 plus the difference between the call and put prices. So 87 minus 70.
Yeah.
17 rupees. So 17,800 plus 17 equals 17,817. That's our synthetic price.
And the actual futures price is 17,830.
So the actual futures, 17,830, is higher than the synthetic 17,817.
Which means the synthetic is underpriced relative to the actual.
So the trade is buy the synthetic, sell the actual.
Correct. Buy the 87 rupee call, sell the 70 rupee put. That's a net cost of 17 rupees for the options legs. And simultaneously sell the futures contract at 17,830.
Okay. And the example showed even if Nifty jumped up to 18,000 at expiry.
Right. Quite a move up.
The final calculation, considering the call value, the worthless put, and the loss on the short futures position, it worked out to a profit of 13 rupees per unit.
Yeah, so Nagnet 87 call cost plus 70 plus 200, call value at expiry, 170 futures loss equals 13 rupees profit.
Which, on the old lot size of 50, would have been 650 rupees profit per lot, before costs again.
Before costs. It shows how that initial 13 rupee difference, 17,830 actual versus 17,817 synthetic, gets captured. But, and it's a big but, the challenges are immense. Market efficiency, like we said. Those high-speed algorithms make true risk-free arbitrage incredibly rare and fleeting.
And execution risk. Getting all those trades done simultaneously at the prices you need.
Exactly. Prices can slip away between clicking the buy on the call and the sell on the futures. Milliseconds matter.
And margin calls. The source mentioned Zerodha, talking about margin constraints, especially when selling puts. If you don't have enough funds.
Your broker can force you to liquidate, potentially locking in a loss. It's a real risk.
Plus, the regulatory landscape keeps changing. Margin rules tightened up. SEBI in 2020.
Right. And more recently, November 2024, the Nifty lot size increased to 75 units.
Making the contract value much larger.
Much larger, somewhere between 15 lakh and 20 lakh rupees per lot. This just ramps up the capital needed significantly.
So let's talk capital requirements, say, for 2025, factoring in these changes.
Okay, for Nifty futures, positional trading, 1 lot. You're probably looking at margin around 1.5 to maybe 2.25 lakhs.
So recommended capital, maybe 2 to 3 lakhs to be safe.
That's a good ballpark, yeah. Gives you a buffer. Intraday might be lower margin, maybe 80K to 1 lakh, but you'd still want, say, 1 lakh to 1.5 lakhs in capital overall.
And for Nifty options, buying is just the premium. Maybe 7,500 to 15,000 rupees, depending on the option.
Right, but for this arbitrage, you're selling an option too. Unhedged selling margin could easily be 1.5 to 2 lakhs, similar to futures.
Hedging helps.
Hedging can reduce it, maybe down towards 1 lakh, but it adds complexity. So for option selling as part of this, realistically, you probably want a capital base similar to futures trading, maybe 2 to 3 lakhs again.
And all these figures are based on that bigger 75-unit lot size.
Absolutely. Plus, don't forget brokerage and taxes on top, maybe 100 to 200 rupees for the round trip per lot. And margins can vary slightly between brokers. Always check with yours.
The key message seems to be, even if the minimum margin looks okay, you need a substantial buffer for risk management.
Definitely. Essential for staying in the game and handling unexpected moves without getting margin called.
Okay, so let's try and bring this all together. Arbitrage with Nifty options and futures. It all hinges on put-call parity.
Right. Spotting when that relationship C minus P versus F minus K is out of sync.
And the process is creating a synthetic futures position using options buy call sell put or sell call buy put and trading that against the actual futures contract.
Buy the cheap one, sell the expensive one, whether it's the synthetic or the actual future.
But while it sounds theoretically risk-free,
The reality is very different. Costs, the need for incredible speed, liquidity issues, the sheer efficiency driven by algorithms.
it makes it really tough for the average retail trader.
Extremely tough. Genuine arbitrage opportunities are rare, and capitalizing on them consistently is, frankly, very difficult for individuals.
So the advice is definitely caution. You need deep understanding, awareness of all the costs and risks, and significant capital before even thinking about this.
Absolutely. It's not a strategy to be taken lightly at all.
Which leaves us with the final thought, maybe for you listening. Considering this dominance of algorithmic trading, the high-frequency stuff, and the capital needed now, how do you think individual investors can best navigate these complex modern markets to find their own edge, their own sustainable advantage?
That's the million-dollar question, isn't it? How do you balance these theoretical opportunities with the hard realities of execution, cost, and risk management in today's tech-driven trading world? Something to ponder.
Definitely something to think about. Thanks for diving deep with us today.